Last week, ADNOC CEO Sultan Al-Jaber confirmed in public statements that even under a best-case scenario, full oil flows through the Strait of Hormuz will not return before the first or second quarter of 2027. This came nearly 12 weeks after the U.S. Israel-Iran conflict began on February 28th, a war that the International Energy Agency has now formally labeled the largest energy supply disruption in history. Despite a tentative ceasefire reached in April, transit through the strait remains more than 90% below normal, and the bypass pipeline that mainstream financial media keeps pointing to as the imminent solution is, according to ADNOC's own engineering data, only around 50% complete. Nonetheless, equity markets continue to rally on every diplomatic headline, apparently convinced that the disruption is a short-term shock rather than a structural bottleneck that will persist for years. So, in this video, we're going to explain why the physical infrastructure data points to a multi-year energy constraint, how Iran has formalized that constraint into a permanent toll regime, and what the 1970s stagflation analog suggests about where global capital is likely to rotate. Let's start with the pipeline itself because there's been a lot of conflation in the press. There are actually two pieces of infrastructure here. The first is the existing Abu Dhabi crude oil pipeline, or ADCOP, which has been operational since 2012 and runs from Abu Dhabi to the port of Fujairah on the Gulf of Oman. ADCOP is currently running at or near its maximum capacity of 1.8 million barrels per day, which is essentially just enough to handle the UAE's own reduced output of roughly 2 million BPD. For context, the Strait of Hormuz formerly carried around 20 million BPD of combined oil and LNG, meaning ADCOP can offset less than 10% of the disrupted flow. The second piece of infrastructure is the new West-East pipeline, which is being fast-tracked under the direction of Crown Prince Sheikh Khalid bin Mohammed bin Zayed and is designed to double ADNOC's export capacity through Fujairah. However, as of May 2026, ADNOC has confirmed it is only around 50% complete, with the target operational date sitting firmly in 2027. While everyone is focused on the diplomatic headlines, the real story is the physical infrastructure, and the physical infrastructure says there is no near-term fix. Saudi Aramco CEO Amin Nasser has echoed this, warning that the oil market may not recover until 2027, and Aramco's own East-West Petroline is already maxed out at 7 million BPD, having itself been targeted by Iranian drone strikes. Kuwait, Iraq, Qatar, and Bahrain have essentially no bypass capacity whatsoever. So we see at least three reasons why this disruption is structural rather than cyclical. Firstly, Iran has institutionalized the chokepoint. On May 18th, Iran's Supreme National Security Council formally launched the Persian Gulf Strait Authority, or PGSA, a regulatory body that requires every transiting vessel to submit a vessel information declaration and pay tolls of up to $2 million, payable in Chinese yuan, digital assets, or in-kind goods, specifically to circumvent SWIFT. JP Morgan's eye on the market estimates this could generate $70 to $90 billion annually for Tehran. The IRGC Navy backs enforcement, and although the PGSA is in direct defiance of Article 34 of UNCLOS, the U.S. counter-response has so far been ineffective. President Trump's $40 billion reinsurance facility had written precisely zero policies as of May 18th, because the problem is not insurance availability, it is the physical risk of vessels being sunk. Pre-war transit averaged roughly 130 ships a day, but according to BIMCO and ICS guidance, current passages have collapsed to as few as 2 to 16 vessels a day, with the entire month of April recording fewer than 200 transits. Secondly, the shadow inflation is already locked in. War risk premiums rose fivefold within days of February 28th. The breakwave tanker shipping ETF has surged over 860% year-to-date, and Cape of Good Hope diversions have removed an estimated 15 to 20% of effective global tanker capacity simply by extending voyage durations. Fertilizer prices are up 50%, fuel prices up 30%, and the FAO has warned of a systemic agri-food shock within 6 to 12 months. This is a hidden, compounding tax on every physical good that moves, and the data backs this up, with Goldman Sachs reporting record global inventory draws of 8.7 million barrels a day. Thirdly, the historical analog is unambiguous. During the 1970s, sustained oil constraints drove CPI above 13% by 1979, crushed traditional 60/40 portfolios in real terms, and saw oil equipment and services indices return as much as 2,000% over the decade. Ed Yardeni has now raised his probability of a 1970s-style stagflationary outcome to 35%, up from 20%. The critical variable, as economists like Barsky and Killian have noted, is duration. Short supply shocks are absorbed by global markets. Multi-year structural constraints produce stagflation, and the 2027 pipeline reality essentially locks in that duration. Ultimately, this is why a number of analysts argue institutional capital is quietly rotating into Hormuz-independent supply. The global offshore drilling market is projected to grow to $45.87 billion by 2031, with the ultra-deepwater segment compounding at 9.8% annually, and operators in Guyana, Brazil, and West Africa offer sub-$30 break-evens entirely insulated from any Gulf transit risk. Whether the broader market wakes up to this dynamic before or after Fujairah's new pipeline finally comes online remains to be seen. But the mathematics of physical infrastructure does not bend to political headlines or central bank press conferences, and the 2027 timeline appears to be set in concrete.